live out on the North Fork, so I'm easy to get to, and we have a lot of information coming from all our panelists, so I'm going to give you 5 things that I think you should walk away with. If you don't remember anything, these are probably the 5 things that you should walk away with from my perspective. A power of attorney, super important. If you have a loved one, you want to get power of attorney for them so that if they become ill, you can make decisions for them. You may think, I don't really need a power of attorney. My spouse and I own everything jointly, or I put everything jointly with my children. The reality is not everything is jointly held. So for example, my wife has an IRA. If she becomes ill, even though I'm the beneficiary of it, I can't get to that money. I can't move it. Or if my spouse becomes ill, I can't get her name off the deed to protect our home. So a power of attorney is very, very important. There's a famous case where a husband and wife were driving upstate and a brick flew off the building at a rest stop and hit husband in the head, and he became incapacitated. His spouse was able to use the power of attorney to move everything out of his name into her name to then protect all her assets and get care for her husband so that he would be taken care of for the rest of his life and she wouldn't then have to live in the road. So a power of attorney is super important. The most probably question that we get with a power of attorney is, who should I appoint? Appoint whoever you're closest to, your spouse or your children. You can appoint them to work as a team or separate. If you have more than one child, who do you pick? Well, that's an easy one. Pick whichever child you love the most. If you're going to stand on your head and swear that you love them equally, I made that joke during a consultation with mom and 2 daughters, and before I was even finished my sentence, one daughter looked at the other one, started crying, and said, "Mom, you've always loved her more," and got up and ran out of the office. So I don't make that joke in the office anymore. But the reality is, pick whoever is closest, pick who's better with money, pick whoever is the CPA or the financial planner, but most importantly, pick someone that you trust that will follow your wishes. If you have more than one child, you can make them work as a team or separate, but if one child lives in Arizona and one child lives in Florida, it doesn't make sense to have them at the bank at the same time. So you can make them separate but equal. A power of attorney does not stay in a safety deposit box, because if you need it on a Friday night, you're not getting to it. So put it in your hall closet, under the blue towel, in the fireproof box, but make sure whoever your agent is, they know where to look. How often should you update a power of attorney? Probably every 5 years or so. Not because it goes bad, but because the institution that you might be giving it to might not recognize it because it's an older form. And especially if that institution has a home office out of state, you need this document to work immediately. So it's kind of a crisis document, so you need to have your agent needs to be able to get to it. Everything else that I'm going to talk about is going to revert back to the power of attorney. So if you didn't do a trust and need to do it later on, it can be done with the power of attorney. If you need home care and we want to apply for some type of government benefit to get it, we can use the power of attorney to do it. It's so important. The most common way that people protect their house, because their house is probably their most valuable asset from an emotional standpoint and from a financial standpoint, is to use a trust. Now, I know most of you are probably not familiar with what a trust is, but a good way to conceptualize what a trust is, or wrap your brain around it, is think of a watering can. I hope there's some gardeners in here. So think of a bucket or a watering can. This is the type of trust that my parents set up. So they put the house in the bucket for the benefit of my parents. The trustee is the person who holds the handle. So my parents made me the trustee, so I'm in charge of the handle for whatever's in the bucket for my parents. This particular watering can has a spout, so upon the death of both mom and dad, the house will leak out to the kids. My sister's name is Kim, I'm Steve, so it gets split 50-50 between us. You'll notice that this watering can has a little bit of a leak in it. So this leak leaks out to mom and dad while mom and dad are alive, if they want it. So in my parents' bucket, they put the house. They keep their star exemption. They keep their veterans benefit. They keep their income tax deduction. They have to pay the insurance. They have to shovel the driveway. They have to clean the windows. If they want to paint the walls orange and green, whatever color they would like, they can paint the walls. If they want to garden in the backyard, they can garden. If they rent the house, they get the rental income. If I get into a car accident and get sued, do I lose mom and dad's house? No, because it's not my house. It's in the bucket or the trust for mom and dad. Even the best kids in life make mistakes. We don't want the kids' mistakes becoming mom and dad's mistakes. So upon the death of both mom and dad, the house pours out of the bucket to mom and dad's whoever they want, but in this case, it's myself and my sister. If they want to sell the house, they can sell the house. It's like any other house closing. House comes out of the bucket, cash goes into the bucket, and they can take that cash and they can buy a smaller house. They can put some in a CD. They can put some in stock. But whatever's in the bucket stays in the bucket. If the stock throws off a dividend, the dividend would leak out to mom and dad. If the CD produces interest, the interest would leak out to mom and dad. If it's in a savings account, it would leak out to mom and dad. What if mom and dad want some money out of the bucket? What if my dad says, Steve, I want to buy a pink Cadillac because the Joneses next door have a pink Cadillac. I want some money out of here. I spent all my other money. Please give me some money back. I would say, Dad, I can't give you the money directly because if I could, then the nursing home or Medicaid would make me give you the money and then I didn't really protect you. However, I can pour it out to the beneficiaries and then we can give it back to you, Mom and Dad. So I say to Dad, you don't really need a pink Cadillac. I think that idea is crazy. In fact, you're blind, you're in a wheelchair, New York State took your license away. There's no reason you need that Cadillac. He says, I don't care, I want it, I want to wheel my wheelchair out to it, I want to roll down the window, and I want to smell that new car smell, roll up the window, and wheel myself back to the house. And I say, all right, Dad, let me think about this. If I give you the money to buy that car, aren't I really reducing my inheritance? Why would I do that? And he says, Steve, as trustee, you're fired. And he fires me as a trustee, and he appoints this young man right here. And I say, whoa, 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 take it easy. I was just kidding. In fact, I just wrote my sister a check, and she's going to bring it over to you right now. He calls her on her cell phone and says, Kim, where's that check? I'm waiting for that money. And she says, Dad, you're not going to believe it, but I went on the internet, and there's casinos right across the water in Connecticut, and I found this system to blackjack. I'm going to triple your money. And he says, Kim, you're fired as beneficiary, and I'm leaving everything to the New York Public Library. So although you are funding this trust, you have a tremendous amount of control. You can change who the trustee is. You can change who the beneficiaries are. You keep all your tax exemptions like the STAR, the VA benefit, the income tax deduction. You avoid probate, meaning upon your death, it pours out of the trust automatically to the kids. It does not have to go through the surrogate's court. You do not need a lawyer to do that. And there's no capital gains tax. So a trust is an excellent planning tool particularly for protecting the house. Home care. In New York, everybody would prefer to have home care and stay at home for the rest of their life. There's 3 ways to pay for that. Either you have long-term care insurance, which is a great idea if you have it, or you can protect your assets with the trust and apply for a government benefit through the VA or through Medicaid. Or you can private pay and use up all your money and then not have any money left. In New York, this is something that most people are not aware of. The eligibility requirements for home care from Medicaid is 1 month. So if you put everything into the trust this month, you're eligible for home care next month. Now I know everybody wants home care. If you went to a nursing home right now, right down the street and said, okay, raise your hand if you thought you'd be here, or raise your hand if you want to be here, no one's probably going to raise their hand. So if you use a trust to protect your assets, you can get home care in New York. So if my mom becomes ill in July, I can use the power of attorney to move everything into the trust, and I can get her home care. So that's a great, great planning tool. In New York, there's something called spousal refusal. If my wife becomes ill, I can use the power of attorney to move everything over to me, and then put it into a trust, and I can get her home care or her nursing home covered. So think of a ship. A ship is sailing up from Florida to New York, and a hurricane's coming. They want to ride out the storm into a safe harbor. The shelter from the storm is the well spouse. So if my wife is ill, I can move everything from her to me to protect the assets, and I can get her care covered. I know that sounds too good to be true, just like there's no look-back period or a 1 month look-back period for home care. That's designed for 2 purposes. 1, they want to keep you home because it's cheaper to pay for home care. And 2, if I use all my money on my wife's care, it's bad public policy then, because then society would have to care for her and me because I wouldn't have a place to live. So you can see how this all works in a row. If you have the power of attorney, you can then fund the trust. You can apply for home care. You can use the spousal refusal to protect all your assets. If you don't have a spouse, then you can't use that loophole. And the 5th thing that I think you should walk away, if there's any spouses of veterans in here, there's a benefit called aid and attendance. So if you're going into an assisted living facility, you can get an extra $1,100 a month towards that care if you have a spouse of a veteran, if you're the surviving spouse of a veteran. So those are the most important things that I think you should walk away with out of here. The bucket is a great planning tool, or the trust is a great planning tool because you're not really giving up that much control. You avoid probate, keep all your tax exemptions, you're eligible for home care immediately. There are 3 downsides to the bucket. 1, you're partnered up with the kids because you made one the trustee, perhaps, and you made the other kids the beneficiaries. So if you want to revoke it, you can revoke it, but everybody's got to agree. If the kids and the beneficiaries and the trustees don't agree, you can fire them and appoint somebody else, so that's not so bad as a downside. The second downside is it works immediately for home care, and it works immediately to avoid probate if you pass away, but you have to stay out of a nursing home for 5 years for it to fully work, to protect for the nursing home. So you don't have to stay alive, and you don't have to stay healthy, but you have to stay out of a nursing home for 5 years. And the third downside is you can't do it on your own. You have to get a lawyer to help you set it up. But those downsides are not that bad compared to the large amount of pluses that come. I want to thank you for your time, and we have lots of other great speakers, so I don't want to monopolize the time.
So why don't we talk a little bit about financial planning as it relates to putting your affairs in order. Peter, maybe you want to start with that and share what people should be concerned about and thinking about as they're thinking about retirement, as they're thinking about estate planning to protect their assets. Maybe we'll start there.
Okay.
Sure, sounds good. Thank you. I think I'll just sit here if that's okay.
There's a presentation from Peter within your folders as well, on the left side of your folder, in addition to his bio, which is on the right side. There you go.
Well, thanks, Lisa. Thanks, Steve. I'm Peter Smith, Catamount Financial Group, and we act as a wealth coach for our clients. Basically, as my practice has matured, my clients have matured, I guess, along with it. And the typical questions I get from them now are, how can I make sure my money doesn't run out before I do? And how can I get a decent rate of return in this environment of low interest rates? So those are the 2 typical questions that we hear from our clients. And I liken our financial lives to a game of golf. So let me ask you a question. Who here plays golf? Who's good at it? Okay. Well, I look at that round of golf kind of like my career. I started in the business in 1973, and the federal government, there was rumblings in the background that they were going to pass this big sweeping retirement plan change called ERISA, and it passed in really, I guess, 74 and went into effect in 75. There was this little clause buried in it that allowed people to put money into an individual retirement account, an IRA, and the maximum back then was $1,500. And I had started in 73, so our business just went out and started talking to folks about putting money aside and sending it ahead to catch up with the need that we were all going to realize down the road. And so sure enough, the front 9, was the accumulation phase for most of my clients, and I think for most everybody in the room here. We sent money ahead in the form of IRAs and in the form of retirement plans. We put money aside for our kids. We paid down our mortgages. We made investments. And then in 2008, an event happened. The first baby boomers became eligible for Social Security. And so a lot of people started playing what I call the back 9. And what we try to do for you is be your financial caddy, try and get you around the course safely out of the 18th hole and onto the 19th hole, which we call retirement. So, you know, when you think of the front 9, I mean, it was characterized by full-time work. A lot of us had pension plans back then. Now less than 30% of us are covered by pension plans. So the onus is now on ourselves as we switch to the back 9 and onto the 19th hole of providing our own income. Some of us work part-time, but typically the back 9 is characterized by part-time or infrequent work and living on what we've accumulated. So when people come to us and they ask us to look at their portfolios, first of all, we try to put a team approach together, so we certainly get an elder care attorney involved and talk about things like this. And along with that, looking at their portfolio, we oftentimes find that folks lack diversity. They've either invested almost 100% in bonds, maybe they got all the money in CDs, maybe it's all in an investment real estate account, or maybe it's all in stock. So lack of diversity is the first cause of really failure in retirement. It's interesting, if we look at what we call now the Great Recession, is what they're calling it. Started in July of 07, ended in March of 09. Typical stock portfolio during that period of time went down 50%, and a typical bond portfolio went up 14%. So the point of that example is to say that a mix of traditional investments like stocks and bonds takes a lot of the bumps out along the way and helps you gain a successful retirement and a long-term retirement. Other things that we see as risks in retirement, oftentimes we'll see people drawing too much money out of their portfolios. The industry standards are really 4 to 5%, and people will say to me, gee, how come if I earned 12% of my portfolio last year, how come I can only take 4 to 5% out? Problem is we don't know when the next downturn might happen. And if we go through another 2007 and 2008, and you're drawing money out of the portfolio, along with having the portfolio go down in value, it can put you in a situation where you just can't recover. The other risks that we find, hidden risks really, inflation. So nobody really knows what we're going to have for inflation over the next few years. We think we're going to have higher inflation. We have hidden inflation right now. The federal figures tell us that we really don't have inflation, and yet every time we go to the grocery store or fill our tank up or pay our insurance premium or pay our electric bill, it seems to be that it's going up. So the other thing we face, and Steve talked a little bit about it, uncertain health. That can really, and good health can sometimes catch up with us too. So like my mother, for instance, is 92 years old and she's in excellent health. She still lives at home, she still cuts her own grass. But she's been very frugal her whole life. That's
that hardy Vermont air.
That's that hardy Vermont air, that's right. And she grew up on a farm, so I guess that helped too. So living too long, unfortunately, can be a burden on your finances. But of course, on the other side, poor health can really come to haunt people as well. Certainly some of what Steve talked about deals with that as well. And then people listen to the talking heads on TV. And I have a friend who's an excavating contractor, and in the winter he kind of works on his equipment. He doesn't work outside, and he comes in about 3 o'clock, and I know when he's watching the TV because he'll call me, all panic-stricken about something that's going on. And I'll say, Mike, and he'll say, yeah, I know, I need to turn the TV off. But unfortunately, that leads to emotions, and it can trigger emotions both in terms of greed and fear, and we may do the wrong thing at the wrong time. So we may own some GE stock and it goes down in value and we think, oh, we got to sell it, and we sell it, and then willy-nilly it goes back up in value again. So the object there is to buy low and sell high, and to make sure that the investments that you have that are somewhat risky in nature and tend to fluctuate in value don't represent money that you're going to need tomorrow. So I think, in summary, the cardinal rules for retirement: you want to invest in such a way that you keep what you have. You want to try and create an inflation-adjusted paycheck. So you want a paycheck that will go up a little bit every year to keep pace with inflation, and you don't ever want to put all your eggs in one basket.
Well, thank you so much. And I think what you commented about regarding, poor health and even good health is a perfect segue for Bob to talk about long-term care insurance and, the benefits of that, and maybe some of the differences between Medicare and Medicaid, and what's so important about that.
Okay. In your folder is this little presentation. What about long-term care. And behind that is also a piece on Medicare, because they kind of go together, but yet separate. But the great news in this room is we're living longer. And statistically, and I think that Dr. could vouch on this, if you reach 80 today, what are your chances of reaching 90, percent-wise? And I get answers 30%, 20%, 40%. Believe it or not, it's well near almost 70% from going from age 80 to age 90. And saying that, that's great news. We're living longer. What happens when we live longer? We're going to get sick. And when we get sick, we have problems. And who's going to be the caregiver or take responsibility for your care? If you're married with children, well, yeah, the children are going to be there as the caregivers. Mom, dad are going to take care of you. Well, they're going to stop working to take care of you. So long-term care, and I have to take away the misnomer, it's not about nursing homes. It really isn't. Nursing homes usually right now today is end of your life, and more nursing homes are filled with Medicaid beds than self-paying or long-term care patients. Because people of our type of socioeconomic level want to have their care at home or assisted living, and they run combined together. And the reason I say this is it goes with Medicare, because Medicare, based on long-term care, and so it has to do with a health issue, but not a health issue that would necessarily be covered by your insurance, whether it be Medicare, Oxford, or Empire Blue Cross. Defining long-term care is custodial care. 2 out of 6 activities of daily living that you can no longer perform on your own. And as I say it, you can see the two that go together. Bathing, dressing, transferring incontinence, and what else did I leave out? Incontinence, bathing, transferring, feeding, dressing. The only, and as you can see, the two do go together. The only one that does stand alone is Alzheimer's, because physically you could do all these activities, but then you're really in danger to yourself. Medicare piggybacks with long-term care if you're coming out of being in a rehabilitation center. So you went in for a hip replacement or a knee replacement, and yes, Medicare is going to give you that 100 days. And that's great. Now, what are you going to do after 100 days? And they say, oh, you can't go home, or if you go home, you need to have care. And that care is called custodial care. Because Medicare very basically defines their care of service, anything that medically is deemed necessary and with improvement. Deemed necessary and with improvement, best card on the street. And the reason I put in Medicare information is because come October, it becomes the open enrollment, and some people have signed up for like the Medicare Advantage plans and don't know and are not sure what is traditional Medicare, what is an Oxford Medicare Advantage plan, and what is a supplemental plan. Being 55 and older is great news today because Medicare is here to stay. Traditional Medicare is not changing, which is important for us because they want the senior votes, our politicians. And they know if they play with Medicare, they're not going to get the votes they want. And the under generation, under 55, I can't speak how that's going to change, and I know it will change dramatically. Long-term care, again, is about family. It's a family issue. It's who's going to be involved, who is the caregiver, and how much does it cost. The cost is really up there, whether it's on the home care level, and home care agencies charge anywhere from $15 to over $20 an hour. And assisted living could be anywhere from $4,000 to $6,000 a month, and then of course nursing home over $120,000 a year. And these are normal numbers, and New York could be a little bit higher. This depends upon your nest egg. If you're going to self-insure, you're taking it out of your own money. And if you're a couple, and it happens to both of you, you're double dipping that much quicker. Going through $500,000 within a 2 to 3 year period is normal, and it can happen. So you're transferring the risk to a carrier. And I know you're going to ask me who, what, when, and how, when should you look into it, and who pays for it, and what's the cost. Long-term care products, and I only work with the carriers that are A-rated, that have been here for the last 40 years when it started, whether it's the John Hancocks, the Genworths, the Mutual of Omaha, just to name a few. They take the risk upon themselves, and what the qualifying event for them is that premiums are based on age and your health. And if you come in later on in life and you have diabetes or you had some strokes or you want long-term care, well, you're probably going to be declined due to health issues. And the younger you are, the lower the premiums. Premiums that someone in their 50s for a really decent product could be as under $3,000 a year. And once you go on claim and the carrier is paying, you don't pay any more premium. Long-term care is totally diverse, but yet the same thinking of life insurance. When you took the life insurance, you're doing it to protect your family and your loved ones should something happen to you. Long-term care, the letters LTC, and I reverse it and I call it TLC, it's tender loving care. It's you doing it for yourself and your children and your spouse. Because if you love them, you're protecting them from the burden. And it really is about the burden. I could tell you about personal experiences that I went through for over 3 years between my mom and dad, and also trying to structure, because neither one could have gotten long-term care, and structuring with an estate elder care attorney to get onto the Medicaid so they could have the coverage. And you have mom denying, I'm not signing any paper. She thought in her mind it's all about welfare and how to protect them. I was protecting them for that there would be enough money to that they could outlive their funds, and also I didn't have the time to be the caregiver. Even though I was a responsible child and the son to take care of their needs, I couldn't do it. So I had to structure a way that I could feel comfortable, that I could go on with my lifestyle. Please, whatever you do, consider the fact that it becomes a real, true family burden. I'm definitely here to answer any questions. You can see me afterwards. But long-term care is a product we all should be looking into, whether for ourselves or even discussing it with your children.
Great, Bob. Thank you so much. So Dr. Feldman, maybe you want to share with us preventative measures to keep ourselves well and live as well as possible for as long as possible.
So I'm Dr. Bruce Feldman. My company is My Personal Doc. I'm a concierge-style internal medicine practice. Fundamentally, I think, if I were to ask people questions, I would say, who thinks the healthcare system is perfect today? Pretty good? Who doesn't know that it's the world's most expensive and not even close to the world's best?
Yep.
Unfortunately, the system is set up to perform exactly as it performs. And right now, the likelihood that it's going to change in any significant way is pretty small. The discussion today has been about essentially restoring one's control. You have the opportunity to find a way to take care of yourself. There are lots of tools out there, and all of these guys have come with the opportunity for you to leverage some things that you may or may not be familiar with. Everybody has a doctor. Everybody thinks that their doctor's a good guy or gal. But when we start to talk about the way the offices are structured today, how many people feel like they spend too long either waiting for an appointment or waiting in an appointment? How many people feel that when the doctor comes in, you actually get the time that you wanted with them? Well, those facts are the result of the insurance structure that is currently in place. For an internist to make the average salary in the Northeast and to staff an office that will enable them to make that salary, they can work, let's say they don't take lunch, they only work 8 hours, 5 days a week, right? That would be a pretty cushy job for a doctor. That's an average of 6 minutes per patient, okay? Now, you could get lucky. The guy ahead of you may only take 4, and then you can get you can get 13. But I don't know that 13 minutes is going to solve your problem. The average primary care guy, they did a study 5 years ago. At that time, the average visit time was put down as 12 minutes. In those 12 minutes, the average primary care patient presents with 5.7 complaints. Now, the primary care guy is very conscientious, so that he spent well over 6 of those 12 minutes addressing the primary concern. So there you are, back to 6 minutes again. A couple of other little tidbits. There is data that supports the fact that if your doctor is unhappy, your quality of care will suffer. So if the doctor is more concerned with you getting in and out, then he's probably not getting a lot of satisfaction from what they're doing. And as a consequence, that may end up, so to speak, in your lap. Now, the flip side of that is there are data that show that the longer you wait for an appointment, either in the waiting room or just waiting to get an appointment, the less likely you are to adhere to the treatment plan that has been prescribed. Why is that? Well, on some level, whether it be conscious or unconscious, you're thinking, well, this guy doesn't respect me enough to see me when I'm scheduled, then why would I respect his opinion enough to do what he tells me? Now, obviously, talk about shooting yourself in the foot, but that's really, I mean, the studies are very clear. There's a linear relationship. So I ask another question. Who has seen in the media, and we had this conversation before we started, the notion that as a patient, you have a responsibility to be prepared when you go to the doctor's office? Seriously? That boggles my mind. I thought that I was the doctor, that I was supposed to get you to tell me what the problem was, not expect you to come in all laid out. Now, maybe I should send you a template that you could fill out ahead of time. Or maybe we could do an online survey that you could plug in the answers to. I wouldn't have to see you at all. I'm going to think about that. That's a good idea. Just kidding. Now, before I started this practice, I have 20-something years of medical director experience, running medical groups, running insurance-type programs. My last job, we had 100,000 people that we were overseeing the care for. We did a bunch of disease management programs, diabetes, heart failure, all kinds of different stuff. I was associated with a large metropolitan hospital. And one of the last things I did as part of that program was participate in a leadership group where we were evaluating certain aspects of health and wellness care. And one of the thing that we came away with, the question that we asked was, and this is of people who are high up in administration in the hospital. And this is a very high functioning facility, okay? One of the top in the country. The question was, if your loved one was hospitalized, would you feel personally that it was necessary for you to personally shepherd them through the facility pretty much the whole time? And the answer, of course, was yes. Well, what does that mean for people who don't have that level of connection within a facility? That's a fairly sad state of affairs. Really disconcerting, and really, for me, nervous-making. So I want to step back for a second. healthcare is a very personal thing. For me, I know that I live for my girls, okay? My girls are my wife, my two little kids, Sylvia and Julia. If I were not around, it would be unnecessarily hard for them. My wife is exceptionally strong. She's extremely talented. She would figure out a way. Her family is extremely supportive. It would work out. But it would be unnecessarily hard. And my girls, I have no idea how they would do because, frankly, my little one, Julia, still doesn't go to sleep until I'm at home, regardless of what time I get home. She's 5.5. Now, many people don't actually even think about that. And clearly, all of the stuff we're talking about today makes you think about that. But I would offer to you that if you're not doing everything for your health, there are people important to you who will suffer as a consequence. So now, a couple of little things. I do heart attack and stroke prevention, and the heart attack and stroke prevention stuff is interesting because there are a couple of little stats that are scary. So, for example, 86% of the people who go on to have a heart attack will pass their stress test. That's not very good, is it? That's the standard of care, okay? Now, it just so happens I have a test, we do it a little differently. We don't even do a nuclear stress test. We do a different kind of test. It's actually easier and safer, frankly. And we can identify underlying cardiac disease much earlier and get more aggressive about it. People think that the heart attack and stroke stuff, or cardiologists do a great job, right? I mean, I have a cardiologist, he's fantastic, he really works. Well, so it's interesting because they measured standard of care. So standard of care is essentially what the cardiologists all agree is what we should be doing. Only 55% of the people who've had heart attacks receive standard of care by their cardiologist, as defined by cardiologists. Okay? The bottom line here is, if you don't have somebody who's looking out for you, who actually knows what the opportunities are, then, you're going to do okay. Right? Because the system is designed to take care of the most people, but that doesn't mean they're going to take care of everyone. And if you're worried that you're not in the most people category, then you need something else.
Thank you so much. Concierge medical services have become more and more prevalent in the very recent times, and only will become more and more valuable as Obamacare and our healthcare system changes. So we thank you very much for that information. And then the other piece, and the other thing that people consider in the aging process and in planning for their estate and their children and themselves is sometimes a reverse mortgage or refinancing a home. Because a home is most people's greatest asset. The thing that they look at in every part of the conversation we're having today. So with that, I'd like to introduce Frank Leone and Tim Kennedy from U.S. Mortgage. So they'll talk a little bit about the differences between a reverse mortgage and refinancing and how those products help different individuals.
Good morning, Lisa. Thanks for having us. Steve, thanks for having us. Frank and I, we work for U.S. Mortgage Corp. We are a direct lender. We specialize in residential homes, 1 to 4 family, conventional loans, FHA loans, and reverse mortgages. Okay, how many people are familiar with or know about reverse mortgages? All right. You probably see about 20 commercials a day, right, about reverse mortgages, and they kind of pique your interest, but they really don't go into the pros and cons, the benefits of it, the misconceptions of it, and maybe the disadvantage of a reverse mortgage. What are some things that you've heard about a reverse mortgage? Anybody?
You live in your house forever.
Good one. All right. I'm looking for a misconception, right? So here,
You have a monthly income?
you can get a monthly income. Okay. Anything else?
Robert Wagner comes to live with you?
All the
Yeah.
Fonz now, Henry Winkler, right?
That's right.
Henry Winkler's in there.
Robert Wagner has a bad track record with wives, so you may not want Robert Wagner, right? Some of the benefits of a reverse mortgage, for example, if you have a mortgage now, okay, you could pay off that mortgage and no longer have a monthly payment, okay? You can create a supplement income, okay, with your Social Security income, okay? If you're having financial difficulties, you could avoid foreclosure. Okay, let's say, for example, you're 6, 7, 8, 9 months behind on your mortgage, and you get a knock on the door that they're going to foreclose on your home. Okay. You could do a reverse mortgage, pay off that mortgage, and again, have no monthly payment for a mortgage payment. Okay. Okay, one of the biggest things, and what I'm coming across now with especially dealing with the seniors, okay, and what they want to do. For example, I'll go into a home and I'll speak to a senior, and they'll say, "Is this something I really want to do? Okay, is this a good product for me? Is this something I should do?" And I'll kind of come to them and say, "Well, I can't answer that question. Okay, this is something you have to answer on your own." And the question I'll come back to them with is, do you want to stay in this home? Okay. One of the big terms you hear these days is age in place. Okay. A lot of seniors, they don't want to move. Okay. They want to stay where they are. This is where they're comfortable. This is where maybe they've raised their children. Maybe their children live around the corner with their grandchildren. Why do they want to uproot themselves from that? Okay. So the first question I'll ask them is this where you want to live? Is this where you want to stay? And when they tell me yes, then I'll say, well, then reverse mortgage is probably a good option. Okay. The other thing I'll do is, did you discuss this with an elder care attorney or an estate planner or your financial advisor? Because as you can see today, there's a lot of things going on at one time, and a reverse mortgage is only one small tool that can help you. Okay. The money that you pull out of a reverse mortgage is tax-free. Okay. And there are 3 reverse mortgage products. There's what they call a fixed saver program. There's an adjustable rate program, okay, and then there's a saver adjustable rate program, okay. And I can go into details after the fact. I just kind of go through a brief rundown, okay. So the benefits of a reverse mortgage, okay. You can eliminate any monthly payments that you may have, okay. You can supplement the income that you currently have, okay. It can help pay for house or home care, okay. You can keep your independence, financial independence, and you can age in place. That's the new term they use these days, okay. Let's talk about some of the misconceptions. Usually when I sit in a room like this and I'll say, what do you know about a reverse mortgage? The first thing somebody will say is, they take my home. I don't want a reverse mortgage. I don't want anybody taking my home, okay. That's the furthest from the truth, okay. You still maintain total control of your home, okay, and you still maintain title to your home. Very similar to what Steve had said about the trust, that in the bucket, you still have total control of your house. What you want to paint it, how you want to decorate it, what you want to do with it, okay? Another misconception I get about reverse mortgages, it's too expensive, okay? The truth of the matter is, it's no more expensive than a refinance on a conventional loan or an FHA loan, okay? And if you did the reverse mortgage saver, your closing costs would be half of what the closing costs would be, okay? It's substantially less if you did a saver program, a reverse mortgage, okay? One of the other Disadvantages, I guess you would say, of a reverse mortgage is, yes, it does eat up the equity in your home, okay? So one of the other questions, or one of the things I'll tell a senior when they're looking at a reverse mortgage is, have you discussed this with your children, okay? Because a lot of times, and we've all been raised this way, is, we want to try and save and protect and give as much to our children as we can when we pass on, right? So the biggest things is what happens to the equity in the house. So you don't make monthly payments, right? Okay, so how does the bank make money? Or how does this work, right? What happens is the interest gets added onto the loan each month. So instead of like a forward mortgage or a conventional mortgage, each month you make that payment, your mortgage goes down a little bit, right? Okay? In a reverse mortgage, each month your mortgage will go up a little bit, okay? I don't want to confuse anybody, I can kind of go over it again, but that's kind of the premise behind a reverse mortgage, okay? How do you qualify for a reverse mortgage? You need to be 62 years old, okay? It needs to be your primary residence, okay? 62 years old, primary residence. There is no income verification like there would be on a conventional loan, okay? There is no credit verification like there would be on a conventional loan. So for example, if you're fixed income and you're sloppy on your credit, okay, you may not qualify for a conventional refinance or a conventional purchase mortgage. That's one of the advantages of a reverse mortgage, okay?
So Tim, what happens, I'm gonna ask a question, what
Okay.
happens when someone does pass, they have a reverse mortgage, then does the family have an option, I've heard that sometimes, to purchase the home?
Yes.
Okay.
So what
Can you explain
happens?
that a little bit?
Okay, so what happens, let's say for example you did a reverse mortgage, okay? You decide either to move, sell the house, okay? Just like you would sell your home if you had a regular mortgage, okay? You have a mortgage of $200,000, your house is worth $300,000, okay? You sell your house at $300,000, you pay off your $200,000 mortgage, and now you have $100,000 that's yours that you put in the bank, right? Everybody understands that process of when you pay off your mortgage, okay? With a reverse mortgage, for example, if your reverse mortgage was $200,000 and your house is worth $300,000, you'd pay off your $200,000 reverse mortgage and you'd get $100,000 given back to you. That's your equity in your home, okay? I'm sorry, go on with, what was that question?
My question was, when somebody has a reverse
Right.
mortgage and they have passed,
Do they have the option to
what-
purchase the
does
house, right?
Can the family purchase the house, or does the bank just take it?
No.
How does the equity that
So
is
what
left
happens-
get
right.
distributed? What is that all
So what
about?
happens now is now you pass, okay? The family has 12 months to make a decision on the house. They can outright purchase the house, okay? Or they can put it up for sale and sell the house, okay? So going back to my original example, if the house is worth $300,000 and the reverse mortgage is $200,000 and the family sells the house, that $100,000 would be split amongst the heirs. Just like
Back to the estate.
goes back to the estate, just like it would if it was a forward mortgage, okay? Another question I get from the seniors was they're concerned that they don't want to stick their family or their heirs or the estate with having to pay out, okay? So let's use that same example. Your house is worth $300,000. You've lived to 90, right? Because if you're 80, you're going to live to 90 now, right? Your reverse mortgage is now $600,000. Okay, but your house is only worth $300,000. Okay, the reverse mortgages are federally insured, government-backed loans. Okay, so what happens is there is no recourse. So if the mortgage is worth more than what the house is, okay, the bank is only going to get what the house is worth, and your estate and your family and your children and your grandchildren are not responsible to pay that difference.
And that's based on an appraisal of the real property at the time?
Yes, right.
Great,
All right.
that's great.
And I strongly recommend, if I get a phone call, somebody that's looking for a reverse mortgage, okay, I would strongly recommend that you speak to your children, okay? Have you spoken to an elder care attorney or an estate planner? Have you spoken to a financial advisor? Okay, and then we'll kind of work it out from there. Yes?
What if you're upside down in your house?
Right now, currently, yeah, that could be a problem. Because a reverse mortgage is equity-based. It's based on the equity in your house, okay? It's based on how old you are. So the older you are, the more money we'll lend you, because, they've done calculations that, the older you are, the sooner you may go, right? The younger you are, like at 62, you're gonna get less money on a reverse mortgage than you would if you were 90, okay? If you're currently already upside down, yeah, that's a problem.
What does that mean, upside down?
Your house is worth, I'm gonna go back to the $300,000 house, right? Your house is worth $300,000, okay? And what's gone on the last 5, 6, 7, 8 years with the mortgage meltdown, a lot of people have mortgages that are higher than what the house is worth.
Okay, I got you.
So that's what we call upside down, okay?
Let me just add too, a lot of clients recently that I've done reverses for, it could be about lifestyle. They want to take that vacation that they've always wanted to, that they have money to do it now. They want to buy a boat. Just some things in life that they've never gotten a chance to do. Now they have the time. They don't have the money, but they have equity in their home. So they access the equity to do a vacation, buy a boat. And again, you do get choices that you don't have to take out a lot of money, just enough to do that vacation or buy that boat. So it could be as simple as a lifestyle decision, Home improvements, a lot of clients, work to be done in the house, and again, whatever work you do, it's your decision. The bank has nothing to say about it, so a lot of different scenarios.
Sometimes the pension will go with the first spouse to go. Now you're suffering from a large loss of income, but you want to stay in this house for the rest of your life, but can't necessarily afford the taxes. So a reverse will enable you to stay. Where sometimes you have long-term care insurance and Medicaid, which is providing the aid so that you could stay at home. But we had a situation where the spouse was a big person and required 2 people to get him into a Hoyer lift to rotate him. And the benefit that they had was paying for one aid but wouldn't pay for 2, so they were able to take out a reverse to pay for a second aid to come in for a couple hours a day.
And the requirements with maintaining a reverse mortgage, okay, is you need to maintain that being your primary residence, okay? You need to pay your taxes and insurance, okay? And you need to maintain the house, for which, for the most part, we all do that. Any questions?
Okay, well, I want to thank all of you for being here. Tim, you mentioned something and you shared with the audience that if they are considering a reverse mortgage, they should really speak to their insurance person, their attorney, and a financial advisor, someone that they work with. So I just want to say to all of you, the reason that we think it's so valuable to put these particular professionals together is so that you can ask questions and they can answer it how their piece fits into the puzzle.